For years, if you held cash, you were called an idiot, but now in 2026, that same cash can earn around a 4% risk-free return. So let's talk about what changed, and let's talk about the options that you have for parking your cash and earning some passive income. The first and the oldest option that we are going to talk about is CDs. And no, this isn't the George Strait CD that you have tucked away in your console. We are talking about certificates of deposit. There are two types of CDs, bank CDs and brokered CDs. Brokered CDs are offered by companies like Fidelity, and bank CDs are offered by banks. With the CD, you are putting up money for a fixed amount of time and guaranteed for a fixed rate. And that's the first pro of CDs, is that you are locking in that rate of return for whatever length of time that you buy that CD for. So there's 3, 6, 12, and they keep going out on CDs. But the pro of them is that when you buy that CD, you are locking in that rate for that amount of time. CDs are also FDIC insured, and they typically have a slightly higher rate than most high-yield savings accounts, which we'll talk about a little bit later on in the video. And overall, they're just easy to understand. You have a certain amount of money, you purchase a CD for a locked-in rate for a locked-in period of time, and when that time is up, you get paid your money, and it's pretty simple. There's not a lot of thinking to it, and it's very routine process. CDs are also FDIC insured, and they typically have a slightly higher interest rate than most high-yield savings account, and overall they're pretty easy to understand. You purchase a CD for a fixed amount of time for a fixed rate. The cons of CDs is that there are early withdrawal penalties that can eat away at that CD return if you do need to pull that money out. So inherently CDs are less liquid than some of the other options we are going to talk about today. State and local income tax also applies to CDs, and then finally they can be callable. So when you're looking at CDs, sometimes there will be options for a callable or a non-callable CD. I usually prefer the non-callable ones, and what this does is it prevents whoever you bought that CD from buying it back from you if interest rates change drastically. So with a non-callable CD, you have that rate locked in until for that duration. On a CD that is callable, a bank or whoever you brought it from can come back and purchase that CD from you, which can limit the amount of time that you earn interest on your CD. So when CDs win is really if you want to lock up a rate for a certain amount of time. Let's say you think interest rates might fall soon, so you want to go and buy a 12-month non-callable CD and lock in a rate now. That's the advantage of a CD. The negative of it is that your money is locked up, and like we mentioned, there are penalties for early withdrawals if you need to get to it. So ideally, you wouldn't put your money into a CD that you'll need extremely short term, but for reserves that you have on the sidelines, it's a good option to make sure that you are earning some interest on that cash. Right now, I'm using a 3 and 6 month ladder strategy with CDs and a portion of my Fidelity cash account. I don't use all of my cash for CDs, only some of it because of how it does get tied up when you purchase a CD. But basically with this strategy, I have them for 3 and 6 months. And when they come due, I go out another 3 months, buy another set of CDs, so that every 3 months I have CDs expiring. And at least for that amount of time, I'm locking in that rate. The second option that we're going to talk about for your cash is Treasuries, and there's a couple different terms to know with Treasuries that will make understanding them easier. T-bills are Treasuries that are under 1 year in duration. T-notes are 2 to 10 years in duration, and then T-bonds are that 10-year plus all the way out to 30 years duration on your Treasuries. The big pro of Treasuries is that they are exempt from state income tax, so if you're in a state where this exists, Treasuries are likely a great option to look into. And similar to CDs, they also allow you to lock in that interest rate, but they can also be sold before maturity if needed. The cons of Treasuries is they are a little bit more complicated and have a little bit more steep of a learning curve, just because it takes some understanding in order to manage the maturity dates. Also, if you want to buy and sell them, the interfaces, I guess, and databases and websites that you use to do that can be a little bit complicated. There's some other videos out there on exactly how to do that, but that is one of the cons of Treasuries, is that they do have a slightly larger learning curve than some of the other options we're going to talk about in this video. Overall, Treasuries win when you want to lock in a rate and you are in a state with a high income tax. They're also backed by the U.S. government, so they have very, very low risk. And similar to CDs, the negatives is that you tie your money up, and there can be a little bit of learning involved with managing the maturity dates or buying and selling them on the secondary market if it comes to that. The good news is there's actually a Treasury ETF, VBIL, and a Treasury money market fund offered by Vanguard that is VUSXX. Both these right now pay around 3.6% on that money invested in those funds, which allow you to get the advantages of Treasuries without the negatives of locking that money up in a long-term Treasury or having to learn the secondary, or having to learn how to sell them on the secondary market. I'm personally kind of updating my cash strategy to include more treasury funds like these, and so they're a great option to park your cash, and they beat the brakes off any traditional savings account. The third option for your cash is money market funds, and these invest in short-term government or corporate debt. The pros of money market funds is that they are highly liquid, so you can put money in today and you can go pull that same money out tomorrow if needed. So there's no lockup period like there is with a CD or with treasuries that we talked about earlier. They're also very competitive when it comes to the interest rate, and they will beat pretty much any normal savings account out there. And then the best part about them is that they are easy to use inside of a traditional brokerage account. So for example, with Fidelity, if you have a traditional brokerage with Fidelity, when you put that money into your brokerage account before you invest it into a stock or an ETF, it actually sits in a Vanguard money market fund that right now earns you around 3.3% on your cash. So you might not even know it if you have a Fidelity account, but your money is sitting in a money market fund at the moment before you invest it. The not so good part about money market funds is that they are usually not FDIC insured, but are what is called SIPC insured. Basically, this means if the brokerage goes under, you will get your money back. Sometimes people will bring up what is called breaking the buck, and this is when basically the dollar value that's attached to a money market fund goes below a normal dollar value. This has only happened a couple times in history, and it's not really a big deal, and it has a very low chance of happening. So I personally think this is low risk in my opinion, but it is a risk that is associated with money market funds and something you need to consider before holding your cash in one of these. Another negative of money market funds is that the rate is not locked in like it is with CDs or treasuries. So you sacrifice that locked in rate basically to have more liquidity with a money market fund. In my opinion, money market funds are kind of the efficient cash option for most people because it's easy to have sitting in a brokerage account on the sidelines. If you don't have that money invested, you can just put it right into a money market fund. So it's really easy to do it like that. A couple of my favorite options are actually Fidelity's, which is SPAXX. This pays around 3.3% right now. And then Vanguard also has another popular option that is VMFXX, and it actually pays a little bit higher, which is around 3.65% right now. So these are both money market accounts. They're very practical, and these are exactly what I use as my primary savings within Fidelity and Vanguard. Coming in fourth, but definitely not last, is the HYSA or high yield savings account. These are the simplest of all the options that we talked about, and they are offered by most online banks, and they currently pay around 3 to 4% depending on which bank that you go with. The pros of a high yield savings account are obviously the instant liquidity, so it operates like a normal bank account. So money that you put in can be pulled out at any time, no questions asked, no penalties. They're also FDIC insured, so this is the traditional bank account insurance that exists with all their bank accounts. So it's pretty much the safest option of any one of the options on this list. And then obviously they're easy. So you open it like a normal bank account, you manage it like a normal bank account as well. The drawbacks of a high yield savings account is that your rate is not locked in like it is with CDs or treasuries. It operates more like a money market fund and will react to what the overall interest rate does and how the Fed changes interest rates over the future. So you can expect this to change up and down if you're using a high yield savings account. The other thing with the HYSA is that the interest rate is usually a little bit lower when compared to CDs, treasuries, and sometimes even money market funds. But like I said, you're sacrificing a little bit on the rate to get that liquidity, to get that FDIC insurance. Overall, a high yield savings account really wins if you want somewhere, let's say, to park an emergency fund and you want instant access to that cash and you want it to be simple and easy to manage. The drawbacks of a high yield savings account is that you're not locking in that rate and you're likely not getting the highest rate available when compared to some of the other options on this list. A couple of my favorites and ones that I actually use are Public's high yield savings account that's currently paying around 3.3%, and then also the high yield savings account offered by Ally, which is an online bank that is currently paying 3.2%. So if you need flexibility, this is your base layer. It's boring, but high yield savings account are a great place to park your cash and actually earn a little bit of passive income. So now that we've covered all four options, I'll do a quick spill on my personal cash management strategy, and maybe you can apply something similar to the cash that you have saved. I have my emergency fund and money that I might need in the next hour in a high yield savings account ready to go. I also have my bigger cash reserve set aside in a Fidelity money market fund. So I actually opened up a different Fidelity brokerage account, and I use that just for cash reserves. So that's sitting in a Fidelity money market fund, which is SPAXX, and that is also where I leverage the CD ladder strategy that I talked a little bit about earlier. So I have my short terms like tomorrow cash that I need, basically in a high yield savings account, and then some of those longer term cash reserves set up in a money market account where I use CDs there as well. So from the 4 that we talked about, you should be able to piece together a cash management strategy that will significantly outperform any traditional bank. Remember, you don't have to swing for the fences with your cash, but cash is really no longer trash like it used to be. Just make sure that you are earning some money on it, and like I said before, it might be the easiest raise that you ever give yourself. That's the video. Hit the subscribe button and check out my free newsletter if you want to hear all of my learnings and mistakes before they even make it into a video. But I hope you found this helpful. Go earn some return on your cash, and I will see you in the next one.